Real estate is one of the benefactors of the global central bank easy monetary policy. Housing prices have gone up faster than penny stocks in some areas, completely defying gravity. Rents have risen as well, and unfortunately for buyers, so have interest rates. This is the key factor when it comes to housing prices. They cannot be sustained with extremely low interest rates. It's simply impossible, unless you come here for a fairy tale. No? You came here for the truth. So let me unveil that for you. Today we're going to look at real estate. I want to cover this specifically from the US first, then to Canada. But I know this problem is also apparent in so many places like Australia, like the UK, and so many other places around the world that I have touched on. But let's get into this right away. Manhattan home prices fall under $1 million for the first time since 2015. So we had a huge escalation in prices in Manhattan, and then it started to level off and it slowed down, and then it was taken down a notch and another, and now we see what is happening in one of the most expensive cities in the United States. Manhattan home prices fell in the fourth quarter, with the median slipping to less than $1 million for the first time in 3 years, as ample inventory continued to allow buyers to demand sweeter deals. The same problems are happening in most global cities. There's a lot of inventory, and suddenly the sellers need to give up more. They need to dish out more incentives. Condo and co-op prices declined to $999,000 in the 3 months through December, a drop of 5.8% from a year earlier. So while $1 million for a property is still very expensive, it's down nearly 6% from year to year. That's important. When you see the trends, that's when you have to pay attention very closely. You can't just say, well, it's $1 million, therefore it's worth a lot, and so on. Oh, I bought it at this price, I bought it at that price. We're looking for the trends here, okay? Many apartments were sold for less than sellers originally sought, with an average discount of 6.2% from the list price. That's up from cuts of 5% a year earlier. Here's the chart that corresponds to that, and you can see what has occurred. Manhattan apartment prices going under the 1 million mark, and you could see that it peaked out what looks like 2017, and you can see the discounts that were given right now. It is exceeding 6% as of this recording. This is important information, not just because of Manhattan, not just because of the United States, but it's a problem that is going on all around the world. Take Sydney, Australia as a perfect example. The home prices skyrocketed in such a short period of time, and now they have declined beyond 10% in a short period of time. That's what happens. The bigger they are, the harder they fall. After the peak comes the decline pending home sales index. You could see that it peaked out in 2016 and has been declining ever since. These statistics keep getting worse. It's not just the pending home sales, but all different types that we've seen here. Pending home sales plunged from a year ago, year over year percentage change. You can see it has fallen into the red quite significantly, and that isn't looking good, not just for the United States, but again, in most major cities. This article is quite long. I just want to touch on a few points. It's talking about San Francisco. Housing is sputtering. Home sales, home building, and home ownership have gone flat, and the rise in home prices threatens to stall out. Things aren't likely to get better soon, particularly for lower and middle income households struggling to make the rent to become homeowners. That is, unless policymakers act. They want the government to step in and do something about it, but the problem is the fact that the assets are too expensive in the first place. I covered this issue previously and how so many people have had to leave areas like San Francisco because, quite frankly, they are too damn expensive. And then you have so many people living in their vehicles as a result of the problems that they face. Housing stats are clear. Sales of new and existing homes have gone sideways over the past year, as has new single and multifamily home building. Housing prices are still rising in much of the country, but the pace of growth is throttling back, and some builders are cutting prices to move houses. Home ownership, which collapsed during the housing crash a decade ago, is just bottoming off and foundering. We are seeing the same problems going on today that we have in previous cycles. This is no different. You get the peak, you get the slowdown, and then you have the discounts. As the inventory builds up, the buyers can start to be more choosy and get more out of the deal. At the bottom bottom of the article, they're basically talking about how interest rates are rising, and obviously that has a major impact on people's affordability. If the prices of these homes move up, as long as the monthly payments remain reasonable for individuals, then they will go ahead with it. But as soon as interest rates rise, that puts a heavier burden on individuals and they can't buy it. They can't get into the market. That's how you have a slowdown. But the home builders only know one thing, and that is build, build, build until there's way too many homes and then panic. This happens every single time. This article here is talking about the situation in Baltimore, and quite frankly, I don't want to get into it, but based on the picture right here, you can see what's happening. Unfortunately, Baltimore is one of those cities where we have such a catastrophe. It seems like a wrecking ball has been thrown through this city. It's unbelievable when you read the statistics. If anybody lives there, I'd really like to know what it's like on the ground. I've heard from so many people in different cities in the United States confirming the data that I have found over the years and tried to bring to you. But anyway, I don't want to really get into it further, but the situation is not good and this could happen in any city. Okay, and now we're moving over to Canada. Canadian mortgage credit growth drops to 22-year low, signaling the end of the housing boom. I'm going to move into the data and just show you all the charts that are relevant to this information. The 12-month percent change of Canada's M1+, and you could see that it has in fact declined year over year. We are looking at the data now, and of course, just like everything else, there's a slowdown, all right? We're moving what looks like around 4% or so, declining below the median, and that also connects in with real estate. The amount of money that people have is all related to interest rates. It's all related to the monetary system, to the central bank that makes all of that happen. They are the ones who issue the money. They create the liquidity or dry it up, and they are deciding that on a daily basis. By the way, January 9th is the next Bank of Canada meeting, so we'll see if they increase interest rates or not, and that's going to have an impact on housing prices. There's no doubt about it. This is a report from RBC, okay? So they had this, showed a lot of different charts, a lot of information. I'll touch on some of them for you. Interest payments surged in the third quarter as Canadian households' indebtedness looked heavier than previously reported. Of course, we get this every time. Oh, we didn't see it coming. How could it happen? Well, all you need to do was pay attention. So let's look at some of these charts in here. Household debt annual percentage change. The average individual in Canada is so heavily in debt, and that is tied primarily to their mortgage. This golden colored line is mortgages, and the blue is non-mortgage debt. While you can see on an annual percentage change, I just wanted to touch on the fact that we are seeing individuals today holding mass amounts of mortgages. Their home equity line of credit is huge. They have second mortgages. They have personal line of credits. They have car loans. They have student debt. They have credit cards. They have every possible type of debt. It has expanded to levels which we have never seen before. And yet the media still portrays this image that everything is just fine. That's a big mistake to lie to the public. You know, if you look at Toronto and Vancouver, the two most populous cities in Canada, you will see the debt to income ratio exceeds 200%. That is completely unsustainable. That is uncalled for. And yet interest rates are still at near record lows. It's a joke. Household debt to income ratio in Canada, credit market debt as a percentage of household disposable income. You're looking at it on a national level, currently at 174. Now that tells me that the cities of Vancouver and Toronto are significantly higher than the national average. Obviously, you're going to have this up and down. Certain areas are much lower, certain areas are higher. But when you take the cities where most of the people are living, you see it's exceeding 200%. And that is dangerous. 174 is already dangerous, but when you see exceeding 200, this is just beyond reason. And the central bank sits back and wonders, should we increase interest rates? I don't know. Maybe we'll let the bubble continue to expand further and further and further, and we'll see eventually the pin meet that bubble. Household balance sheet, Canada as a percentage of household disposable income. You're seeing both of these while they have stalled over the past year. I just wanted to note the fact that this has expanded greatly over the last few years. Why? Because people have more debt. They took on mass amounts of debt because of their houses, because of their cars, because of all the different new debt instruments that you can have. You know, I don't know about you, but every time I log into my bank online, every time I go to my mailbox, every time I turn on my television or radio or magazines or newspapers, there's an offer there for a line of credit. It's ridiculous. It's unbelievable how many times they are offering. Just call this number and you can get a free line of credit. You're already pre-approved. Trust me, don't worry. Bad credit, no credit, can't spell credit. It doesn't matter. You will get that money. All right, they make an offer every single day. Debt service payments, annual percentage change. This is the household disposable income in the golden color and debt service payments in the blue color. Just wanted to show you the fact that the disposable income seems to be declining right here in terms of what people are able to pay, and that's not good. The average person today is so heavily in debt, they're at the max, and I don't know how they're going to expand this bubbling further if this continues the way it has been. And last but not least, debt service payments, annual percentage change. You're seeing principal payments and interest payments. Interest payments have risen considerably over the last 2 years basically, and that is not good because the average person today is dealing with more interest than ever before. The amount of money that they pay towards interest is increasing because interest rates have increased. At the same time, they're taking on bigger and bigger mortgages, meaning they got to pay more interest on that. They're dealing with variable mortgages, but in Canada, the way it works is that on average, you actually get a mortgage for 5 years. After that 5 years, then you have to renegotiate. And a lot of these people, they have to renegotiate into much higher interest rates, and that's why they're getting screwed today. And every time we're going to see this over next year and the year after and the year after, higher and higher mortgage rates as a result. I'm going to finish the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. This is the most data dependent channel that exists. I bring you as much information and I squeeze it into a video every single day. I try to get 2 videos out per day. If you're new to the channel, I want to say hello to you. 170,000 people from all over the world in one of the most informative comment sections you're going to find anywhere. The people in the comments are so generous with their information, giving even more data to back up the facts that you're seeing here. It's incredible. So I urge you to share your information whenever you have it, because these videos here, while I can try to cover as much information as I can every day, it's you who has to help out and try to put in little tidbits where you can get that data. I really do appreciate that very much. Thank you all for sharing your information in the comment section. I read as much as I can. You know, these days it's becoming very difficult for me to reply because sometimes I spend an hour replying to people and I barely even get into how many comments there were in the last little while, but I try to give the thumbs up and the little heart icon, and I find sometimes it doesn't even stick, but I try to anyway. But that's it. I'm going to stop ranting. If you found the video informative, I know you'll find my books even more informative. You can actually flip through the books for yourself at Amazon. There's a link in the description below. And if you want the audiobook version instead, you can get that at themoneygps.com.